Welcome everyone to MT Live. We're going to get started in a minute here. And there we go. Okay. All right. So it's Wednesday. Dan and I are here on YouTube, and then you guys are in our room. We love doing this and sharing how we view the markets and trade and our analysis and how we come to conclusions as to what we do, why we do it, and explaining that to you and taking your questions. So let's get to it. We're going to talk about, can technical analysis really predict price action? There's a lot of debate on that as to different methods or philosophies as to how you trade, especially when it comes to options trading. Everybody that trades with charts would say, yes, you can predict price action based on technical analysis, but there's so many different ways of coming to a conclusion about technical analysis. It's one of the hurdles that everyone has to deal with. I know I did at the beginning because you're inundated with the indicator-based methodology and the holy grail type of methodology of predicting the future, whether that's through Fibonacci extensions, Elliott waves, squares of 9, and or Gann angles, planetary alignments. Is it a full moon, a new moon? If you haven't heard such a thing, believe me, it exists. I even dabbled on the dark side of that craziness at one time, where before they were charting programs and would plot charts by hand and take note of Fibonacci time cycles into the future and take note whether it was a full moon or a new moon. I was full blast into the holy grail syndrome of I am going to be able to predict the market to the day. People that I studied with, they were talking about, some of them was to predict it to the hour, believe it or not. It was pretty incredible. You know, so once every 12 or 13, 15 years, it has to be a fib number, right, as to when it would actually happen. But, you know, when it did happen on that day, on that hour, as it all came through, it would sell courses or whatever. But it came to the conclusion this was a crazy way to try and trade, because inevitably in the moment you have to make a decision. Am I going long? Am I going short? Or is this still not a setup? So as we do it, there are still that decisions, long, short, or sit on your hands, as we call it. But we do it in a systematic way. And we're going to give you some insights as to how we do it. We're going to talk a little bit about option strategies and how it applies to that, because that's where the real rub comes, as I see it, with those that trade options through what's called the Greeks and volatility. And as I learned more about that, I really scratched my head as to saying, how could any of these people be doing this without a chart, or saying that it just doesn't make sense to look at it? So we'll get into that. It's a great conversation, and no better person for me to have that conversation with than Mr. Dan Gibby.
Hey, Greg, welcome everyone. And yeah, I just wanted to kick in there and say it's not just the option traders, and we're going to show you our position today, why we believe it works, why it does work based on objective information, but even fundamental analysis for long-term investing, the hedge funds, somebody who took a finance class and wants to crunch numbers and say, Kimberly Clark has great financials, so I'm going to invest in it. You're going to see, though, I don't care what methodology you use, it's our opinion that not using technical analysis as a timing indicator to overlay on top of whatever methodology you use is a big, huge mistake. And we as you know, we consult for high net worth individuals, hedge funds, family offices, and some of those come to us with their stocks and commodities of interest in ETFs, and they run them through a fundamental filter. They run them through whatever filter they want. We don't care. But we together are the experts in using technical analysis, both not only to help them time entries, but to manage them, both for target, stop loss, option adjustment strategies to increase their returns.
So yes, you can predict the direction of prices, and sometimes there's no direction, which we'll take a look at. It may frustrate some. It's directionless, because how do you make money if it's just sitting there doing nothing? Well, you move on to something else. Right. It says there's various ways to succeed in this, and you have a choice as to what that's going to be for you. It says they're fundamentals, and I'm not totally against fundamentals. I mean, there's a lot of lies that have gone on about that over the years. But those that use fundamentals to come to a conclusion as to the value of a company, undervalued, overvalued, it's valued information. It can be, but you don't know what you're being lied to about. But if you can combine that with technicals, you're really head and shoulders above those that do not use the technicals. And that's why we use it. So it tells us about price action, what others are doing, what's the trend, are there patterns? Well, you have to learn the patterns, of course. So there are patterns that mean confusion, there's patterns that mean certainty, there's patterns that mean reversal. And when you learn that certain patterns, when you combine that with the trend and the location where they occur in multiple time frames, that's where the odds really go up in your favor. So it says.
Yep. So what is technical analysis? Just a little basic definition. What is it? What are we doing here staring at these charts?
Trying to predict the future.
Right. So we're analyzing current objective price data, and like you said, in terms of trends, patterns, individual bar recognition, and we're taking the messages from that and predicting a future direction. So why on earth does that work? Why is that not looking in the rearview mirror?
Well, of course, it is looking in the rearview mirror.
So why does it work?
So what you're doing is you're looking you're looking at the past, and you don't just look at the past in one occurrence. You look at the past like I have, and I've been doing this for a long time. I'm just throwing out a number, but let's just say it's 10,000 times, 100,000 times. And when the past looked like this is history. I mean, what do generals do that study past battles? And they say when certain things happened and this was the outcome based on these strategies, this was a winning strategy. And we do the same thing as technical traders. So we look at the past, and we look at occurrences, and we look at differences, and what changed. Why didn't it work this time? Is there a common denominator as to why things work and when they don't work? And as we do that, now we have a greater odds of predicting the future direction of prices based on that study of the past and seeing what the present looks like. And then you put your money at risk based on those odds, those probabilities, and then you wait to see what happens. It's that simple. Perfect.
But also just because, we're trying to layer concepts in for folks today, but this third bullet, you have to let it sink in of what it means. So everything we're looking at here, what we just said, the patterns, the trends, the bar analysis, every tick meaning a buy and sell order on whatever instrument you're looking at, stock, ETF, currency, commodity, is an actual trade. There's many market participants on why they wanted to be a willing buyer or willing seller. They have different reasons for trading, investing, technical, fundamental, Fibonacci, etc. But here's why it works. The summation of all of these collective market participants that want to buy, want to sell, that is reality. The people on TV can lie. That's why we say the charts don't lie. These are created by the cumulative total of market participants. And so we want to trade on the side of the person in charge of the stock. If the buyers and sellers are in a rough agreement of the value of a stock, it's going to bobble around and trade sideways. If there's more demand for it than supply, then the prices are going to go up and it's going to be an uptrend. Regardless of the news, even on bad news, the reverse is true. We'll show you a chart of Enron here in a moment. It was a Fortune 100 company with the most, or Fortune 10 rather, with the most phenomenal fundamentals, but the chart says it's going lower, but we'll come back to that. So yeah, let's just move on here. So Greg mentioned that, you know, Tasty Trade is a huge option financial network, and they're ones that say nobody can predict charts. So I actually hope some of those viewers are live with us right now or watching this later, because I assure you we are going to change your mind, you know, different amounts depending on your background. And we said that
Personally, I mean, I don't follow their trades much, Dan. Actually, not at all.
I don't even.
They have been pointed out to me, and it just boggles my mind how much. Look, they are so smart. I mean, the people doing the research there and their statistics, very impressive. But when I see certain things that are done, it's like, wow, if you would have added a chart to those statistics, how would they have changed the statistics? So the statistics, I believe, are misleading because of the exclusion of a chart pattern.
You and I are obviously in the same mold, and we're going to dedicate a post-market webinar on this exact subject a week from tomorrow. So,
right. So, you know, we have a lot of options traders that come to Master Trader, as well as stock traders that trade the underlying, of course, of whatever it is. And we all do it with charts. It doesn't guarantee a profit, but certainly you avoid that that black hole of falling into the never-ending rolling.
That's right. Yep. Well, yep. So Greg summarized the Master Trader approach earlier, but you know, very simply, because we just explained what charts are. They don't lie. They collective beliefs. We want to trade with the party in charge. You know, bull or bear or sideways consolidation. Our methodology, very simply, is looking for that high probability setup. Then we enter and manage per our trading plan. And that's it. That's what trading is. Objective or subjective, and you know, your goal is to master your approach to the markets. Greg also mentioned what these patterns do. They communicate what traders are doing, what they're feeling, because again, they're showing the end result of these collective beliefs. Greg, you love the term candle language. Why don't tell them what you mean by that?
Yeah, so you know, some of this terminology I came up with years ago as a way of, you know, just educating, communicating as to what are we really looking at here, you know. And I came down the same path as all of you, right? You probably read most of the same books. So with candlesticks, they get into all of these names. ramis and dark cloud covers and piercing patterns and morning stars, and the predictability of these patterns. They go into this long thing, you know, different educators that want to get into the candles in that way to say, oh, you know, this particular candle has a predictability of such and such. Well, it's nothing could be further than the truth, because all of these patterns, when you change time frames, the patterns change. So unless you understand multiple time frames and trends and locations of where these patterns occur and retracements, you lost, you losing candles, because you just down in that same maze of confusion as the guy drawing trend lines all over the place, trying to figure out which way prices are going. And so I call it candle language, because what we do is we take a candle and we know, hey, if it's a green candle, we color it green, and it closed above its opening price, well, that's a plus. Where did it close? Where did it open? Did it open at the bottom of the range and close at the top of the range? That's a plus. Doesn't matter what you call it. Was it preceded by a big red candle? And now I got a big green candle that reversed the red candle? That's a plus. Is it an uptrend? Another plus. Did it pull back to an area of minor support? Plus. So it's step by step. Now, what if it was a bottoming tail bar? What do you call a bottoming tail bar in candle books?
Bottoming tail.
Hammer? I don't know. It really doesn't matter. It went down and it came up, so it's got a tail. So as we look at retracements within a bar or between bars, and we look at trends, who cares what you call it? I know that that's a bullish turn, or it's a bearish turn, or these candles just say, nobody knows what the hell's going on, right? It's just a giant mess. And that's a picture of uncertainty.
And yeah, so just answering Tony's question here about, he's saying, you know, I'm paraphrasing here. I don't know if he's implying that Tasty Trade doesn't use charts because their time frame is 35 to really 45 days is what they sell, is their magic number of selling options. And I disagree with that, because technical analysis applies to any time frame whatsoever. We have a master trader ETF investment letter, which focuses on long-term holding periods from months to, you know, weeks to months. So our tools of technical analysis is a compelling pattern on the weekly. We need to go up to the monthly to make sure it's a price void, and then we can go down to the daily to perfect our entry. So that just affects your trading time horizon. But technical analysis applies to a 1 minute chart for the reasons we already spoke. It's active buyers and sellers on a 1 minute chart of what their collective beliefs are on a short-term basis. All right, let's continue. But Tony, please come to our special session on the 24th, and we'll walk through many more of those concepts.
I have questions and comments about what he said, but I don't want to take the whole session with just that discussion. But I mean, they're saying it says they don't think you can accurately look at a chart until 35 to 55 days out. Well, does that open the door to say if they look at a chart, they can tell what's going to happen 2 days out?
No, they clearly say
50 days out?
No, they say nobody can predict direction. End of story. Okay. All right. So yeah, let's continue here. I found this this cute little comic on a research earlier, but reality in the trading in world is what you're seeing before your eyes. You know, people lie, fundamentals lie, emotions of greed and fear are going to move what fundamentalists say, oh, they got oversold or overbought. But reality is what we're looking at. So we're trading reality. Perceptions is what we call subjective information. It could be perceived in one's mind or facts based on something else, but it's everything that's not reality. So look at the cute little comic here. This one guy says, yeah, I'm saved. And the truth is, you aren't saved. It's your perception versus reality. If you see this little guy floating up to your little island. But, I'm not going to read through all this, but I'll show you in some charts here of what we mean here about reality versus perception. Exhibit A. This, Enron was in the dot-com blow up, but it was a Wall Street Fortune 10 darling, as I mentioned. Look at these beautiful fundamentals, year over year increase. And the stock went from there in 2001, it was around $90 down to zero. Look at that downtrend. I don't care what Enron's board is telling you. I don't care what CNBC is telling you. I don't care what analysts are telling you. Reality is that is a nasty downtrend and that stock is being dumped. Supply is overwhelming demand. And that's why I don't care about fundamentals. Stocks can go up on bad news. They can go down on good news, etc.
Well, fundamentals, Dan, give people hope. And that's, there is some validity to crunching those numbers, of course, if they're true.
Well, and I already gave the caveat early. I have no problem if people want to use fundamentals as their screening tool and technical as their timing. So whether they're true or not, I don't care, as long as it meets. As long as it meets your screening tool of what's called a bullish fundamental, maybe let's just take Investors Business Daily has a 5-part ranking system of fundamentals. And let's say you're only going to trade stocks that have, A or above, just A's, straight A's. Enron was one of those. So as long as you use technicals as your entry criteria, I don't care that Enron's an A+ student on IBD. I would never enter it.
The point I wanted to make was that people that they have an advisor, a broker, and the stock's going down. So, well, it's still a solid company. The fundamentals are still good. This helps alleviate the stress of the correction and being down maybe 20, 30%. It doesn't mean it's right, but it's one of the things that people get hooked on. And
absolutely.
So when that happens, they can experience a devastating loss if it's a lie like an Enron was, or, is it just a market correction? And that's the plus with these stocks that say maybe the fundamentals are good. I mean, if you look at the price history of companies today, like whether it's Amazon or whatever,
Apple,
you will see that they have gone through 40 or 50% corrections at times that were mostly related to the market. So do those fundamentals keep you hanging on when you're down 54%? I don't know if that makes you sleep a little better at night, but I know that's what a lot of people do.
Absolutely. Yep. And Apple's a good example because everyone loves Apple, and it's been a downtrend on all time frames. This is just what we call the market atom, and it just shows the only possible movements that a stock can make on different time frames. And technical analysis shows us this. So we're in a sideways consolidation prior to a breakout to an uptrend where the demand is greater than supply, and we call that the greed. And we have the strategies to know how to buy pullbacks to support breakouts until the trend ends, and then it goes into a downtrend. So as long as you know this atom on whatever time frame you're trading, and then master trader teaches you what to do in every single one of these stages, then trading becomes, Greg likes to call it factory work. It's mechanical only in the sense of we know what to do in any environment based upon the master trader strategies, but it's still ingrained in technical analysis. This is our stage 2 uptrend, higher highs, higher lows. And then all we're trying to do is get on this uptrend at the proper times. Where are those times? Pullbacks to support with a reversal bar and bullish consolidation breakouts. I don't care what the news is. I don't care the fundamentals. I don't care what the company does. As long as it's liquid and I have a compelling pattern on multiple time frames, I will be trading this particular instrument.
Yeah. Well, it's the basic stuff, Dan. And we, of course, we don't know who's in the room. There's a lot of people, but just going through these basics of some of the terminology, what's minor support, major support, and following the trend. It's really foundational information, but it's powerful because this is what we come to with the time frames that we're going to use. That slide that you have up there is to show that what we call a macro stage 2 is just to say, hey, that could be a weekly chart. It could be an hourly chart if you're a day trader. And the micro ones could be a daily chart if you're a swing trader, and a 5-minute chart if you're a day trader. You get to choose the time frames. And it's just to say trade in the direction of the big time frame. And then if you're going to be a buyer, buy pullbacks. It's simple, but it works.
And you don't check the fundamentals before you buy on that pullback?
Of course I do.
Kidding, folks. All right, so that slide was an uptrend. What is it? This is just our simple definition of what is a trend. An uptrend is higher pivot highs, higher pivot lows, and a pivot is just bars on each side of where price change direction. That's an uptrend. And we just showed you we're buying pullbacks to support. Sideways trends, relatively equal highs and lows. We have strategies to trade both of those. We could short resistance, buy support, sell out of the money put spreads. And then a downtrend, obviously the opposite of the uptrend. Lower pivot highs, lower pivot lows. We're going to short retracements to minor resistance. I just showed you an example here or two on some stocks that we traded. And again, just to help you visualize how technical analysis works. Now, Dollar Tree here, multi-month trading range. You got the big daily there, and then the upper left, I'm showing you the weekly chart also. But notice every time it came down, buyers came to the marketplace to say, I'll buy some Dollar Tree in the low $82 every time it came back. So that floor of demand is what we call major support. So who says that this chart is not giving me valuable information that charts work? Buyers, the collective market participants, I don't care, again, the basis for them wanting to buy it at the low 82s, that is showing me where major support is. So in our advisory letter, we actually sold an out of the money put. I'm not here teaching options today, but that's one of our income strategies where we say that stock's not going down, and we sell an out of the money put option to somebody who thinks it's going down for whatever reason, fundamental, technical, but they want to protect their portfolio. I don't know the reason, but we're willing to take that money and say, I don't think it's going lower. And so that's one of our income strategies. You see where it broke out of the weekly chart. So now it went from a sideways trend to an uptrend. How did that happen? There's only one possible reason. The demand for the shares of Dollar Tree were greater than the supply at that price level, and people were willing to pay higher prices, which made it break out.
You know, again, something that I don't think is explained in any technical analysis book. In that, when you see patterns and what you're explaining here in multiple time frames and what's likely to happen is that, you know, we have this area here that's going through a bottoming process, and everybody wants to buy at a lower price to you're going to make more money as it goes up than paying at a higher price. And, you know, if it goes higher, right, continues to go higher. In any event, what I'm saying is what isn't covered is that, well, we can say, well, why can't we be a buyer down here on the bottoming tail bar? Because we know that this is going through this bottoming process, right? Well, you can, but you cannot have expectations of the buyer that's buying the breakout that's anticipating this kind of momentum style move. If you're a buyer down here, you have to be patient. You have to have wider stops. You have to sit through the jiggles. And so when you get into a trade, your expectations about what the future is going to be has to be measured with what the chart says. So you can be a buyer down here at this major support, but don't expect that it's going to do this right away.
Particularly in this pattern with all the overlapping bars, you know, et cetera.
Sure. So, you know, and that's exactly a bottoming pattern. That's what it does. You have these overlapping bars. But once you begin to see evidence, not clear everything, evidence like this, you know you're getting closer. And you see things where these moving averages are coming tighter together.
And that's when we saw the puts. Yep.
Shorter term ones are beginning to flip up. So there's a lot of little clues or nuances within the way we look at the charts to say, look, if I'm going to buy this here, it's going to take a while. So I buy a little and wait. And if it jiggles around, it's doing what it normally going to do. But when I start to see these little clues popping up, it's like, oh, we're getting ready. Or sometimes you'll get into a trade. I know I get into a trade and right away it goes against me. You know, I'm like, damn, oh, not again, whatever, you know? And then the next bar or two, it flips right back up again. And that was a jiggle. And then I am thinking to myself, I got it, right? So there are things that can happen that are just so enlightening, you know, where it's like, okay, this is it. And that's what I'm trying to point out here is that certain events will happen that say it's ready to move. And other times it's like, okay, you want to participate here, you're going to sit through the jiggles.
Yep. And then, you know, again, we have option strategies that where we profit by sitting through the jiggles.
Yeah.
Another example, again, just think of the collective market participants. It was going sideways in April there. That's a sideways trend, doing nothing, flat moving averages. And then we had an explosive volume in early May, big wide range breakout bar. So I don't know what the news is. I don't care. I don't know what made that big bar happen, but that's a tradable event using master trader strategies. That's what we call a wide range igniting bar. We can swing trade it, sell out of the money puts. Then it advanced a little bit, had a multi-week consolidation over time above the 20 period moving average, and it broke out again. This is an example of us buying pullbacks to that breakout area is the minor support. You don't just do it blindly because you need to make sure that it holds. And that's why we look for a reversal bar. We got our reversal bar, we got our bottoming tail, the next bar, and that was our turn to say, okay, people are now stepping up where they should in this uptrend. And that's where we put our money on the line. I don't even know what EIG does, EIGI. I really don't. But we traded it because the charts, the bars and the pattern and the trend is telling us who's in control of the stock. And that is the only way on planet Earth that you're going to profit in the market is buying low, selling higher, or shorting at a value and buying it back at a cheaper price. All we're doing is exchanging inventory similar to a retailer, similar to Nordstrom, buying their stuff and selling it at a higher price. Our inventory is just stocks, options, commodities, currencies, ETFs.
Go ahead, Dan. I was just answering some questions on YouTube.
So these reversal bars that I'm talking about on uptrends, pullbacks to minor support, downtrends, we want, and look how simple we keep this. Pictures of selling. Well, let's start on the one on the right. People like a bullish mindset. So we have an uptrend. We've defined what that is. Higher pivot highs, higher pivot lows, and we're hoping, expecting for them to come back, retrace like Iggy did to minor support. We don't do it blindly. We're looking for these pictures, these candlesticks. We're looking for pictures of buying. We don't care about the names of the candles, but these, and they come in all types of different shapes and flavors. But these two pictures are saying the buyers are now taking back control, that the retracement is over, and that's where we get on board. The one on the left, we have a downtrend, and you can either short breakdowns from consolidation or these retracements to minor resistance after you see pictures of selling. It's that simple, folks. That's it. These are, I'm going to show you 4 different great reversal patterns. The first one here, just that's what we've been talking about, a retracement in an uptrend. Let's just focus on the top ones. So that's a retracement in an uptrend. I got my red bar followed by the green bar on minor support. That's where I'm getting in. We actually love this W bottom retest, called a retest and failure. It pulled in, it came back, the buyer stepping in at that prior low again. That's a W bottom on support. We couple it with multiple time frames, time it with the internals, and that's a fantastic entry. We'll do a little bit of scanning here together in a few moments, and we'll show, we'll scan a number of things and we'll show you, we'll point out both awesome places to enter, and we'll show you some patterns of if X, Y, Z happens, we will be interested in either buying or shorting something. This little flag pattern, that's a strong uptrend. Why? Because the stock did not retrace. It is a bullish consolidation in the upper 1/3 of that prior advance. So it's the fact that something can't retrace very much is a sign of strength. So that's another area to get on board long. Next one, just consolidation. That's going to happen in any trend, just obviously up, down, or sideways. They will have a much higher probability if this consolidation is in an uptrend or sideways trend. When you get consolidations in a downtrend, then it's a consolidation in a downtrend until proven otherwise. And just as a side note, we've been doing these MT lives for I don't know, 8-9 months now. And we have them at mastertrader.com under the resources tab. And we did everyone's been an awesome topic, I have to say for myself. But this one reminds me of the one we did on buying bottoming patterns. So stocks that have been crushed and they're consolidating. We're looking for what we call this potent retest pattern. And we went through a bunch of examples showing how to intelligently trade these bottoming patterns. Yeah, Robert will definitely take a look at Caterpillar here. So Greg, anything else before we move on?
Got the basics there.
All right, so this is Greg's phenomenal course that he completed a couple months ago, the swing trading course. And that's what we've been talking about here the whole time so far. He calls them thought building processes, and that's our factory work, putting all those thought processes together in a methodical way, set up, action, manage in between. That's what he teaches you in that course. And we're going to offer to you here today his advanced management strategies course for free. So you buy the swing trading course for $7.95. The advanced management strategies is also $7.95. We're going to throw it in for free because the importance of having proper money management, like so many people just love the pattern. Show me the pattern, I'm going to, buy 1,000 shares. All that sounds great and it's exciting, but you need proper money management to succeed in this business. And this is a business, and you should approach it the same way. Our Master Trader Green Trading Room is our live trading room where we start at 9 a.m. Eastern. Greg does a fantastic overall market review. We come up with our trading bias for the day, both for day trader, swing trading. And then we look at gaps, open positions, come up with our focus list, great education, going back and forth all day long, looking for new trade ideas. Go to mastertrader.com/green trial, and we give a 3-day free trial. Come check it out, watch, learn, ask questions, and you will see us in real time doing what we do. All right, why don't we take a look at some charts here. Audrey, show me your money management. That's funny. And that's why Greg's pulling up his charts. Just another comment I'm going to throw out there about money management. That, we all get these free newsletters or trade pick ideas, whatever. And it actually is shocking to me, Greg, that as I'm sitting here thinking, I can't think of a single one, Greg, that sends out free, trading newsletters that says, here's the pattern, they give you the suggested trade, but I can't think of one that says, and here's your trade management recommendations. That's crazy. I mean, we don't enter a position without having a proper trade management strategy ahead of time.
All right, what are we looking at here? So there was a question earlier, Dan, that was posted in the Q&A versus in the chat. They said, it seems on the monthly basis, the S&P 500 stock only goes up with the exception of 2000 through 2008. Should you always assume an uptrend if you trade the S&P 500 on a monthly basis? Well, yes.
No. I say no. I mean, the monthly is cracked. Let's take a look at it.
He has to define the trend, right?
Well,
on a monthly basis, I don't even know that he knows how to define a trend.
I thought his question was, which we need to address right out of the gate, is he said it's always in an uptrend. So why don't you point for the benefit of that person and others? Yeah, just scroll back wherever the heck you want and just talk about uptrend, downtrend, sideways trends. Because the fact, if this person assumed it's always in an uptrend, that's an incorrect statement.
Well, right. So he said 2000 to 2008. So there's a lot of things to point out. So the first thing was, how does he even define a trend? He could be totally wrong, right? So this was not in an uptrend here. And this was 2000 through 2001, but 2003 to 2007 was in an uptrend. Then it broke down, went all the way back down to the low. So here it was in a downtrend. And here it bottomed out and it started in an uptrend again. So this type of pattern clearly was an uptrend, a tight uptrend, a lot of certainty. It didn't even pull back on the monthly time frame. We know that this was a pullback on a weekly, of course, and a daily. And then, 2015, 16, things got choppy, and then it resumed the uptrend again. And now prices have violated that uptrend at this time on the monthly time frame. So it's no longer in an uptrend. So you can't assume anything unless, well, you shouldn't assume anything, but if you define an uptrend and a downtrend properly, if it's in an uptrend, it's black and white. It's in an uptrend. If it's not, it's not. And here, it's not. And so we just define an uptrend like in a simple way, is it making higher highs and higher lows? And then we mark off what is major support, which is the low prior to this higher high. So it was in an uptrend, and now once it's broken through it, it's now not in an uptrend. It's not in a downtrend yet, but it's not in an uptrend. So you do not want to just assume it's going to go up anymore.
Well, and why don't you explain why it's not a downtrend and what could be a picture of our lower high?
Sure. Oh, it would make a pivot wherever that might be.
Right.
And would go down.
Right.
So now as this pivoted, it's now created a support area that wasn't there. Because, from here to here, that momentum move, there's nothing as we look at it in this time frame, because the advance was so powerful that it didn't consolidate or create any swings. But now it's making a swing low. So the question is, right now, because it's broken the trend, we do have to make an assumption that it's not going to go up like this. And I think we'd all agree with that just because of the way it came down. Now, the unknown is whether can it continue to go right back up again, or is it going to roll over here and keep going down? Will it stop here and form this kind of a pattern as it did back in 2015 and then resume the uptrend? We don't know. Right. So it's not in an uptrend. I'm not sure if it'll keep going up. This is a very powerful bar, right? This was a powerful bar. This was a powerful bar. And now you've got some stabilization. That's it. Now,
so show me
coming up into what is going to set up as a sell setup. And we're waiting for that to happen. So far, we've just got green bars going up on the weekly.
And it's at resistance, which is the prior breakdown area. But recall what we said a number of times. We're now looking for pictures of selling for a reversal bar to get our swing trade short entry. We don't have the swing trade short entry yet because of the strength of the daily and weekly charts. We're always looking at multiple time frames. We have been hoping and looking on the daily chart for our short setup. But if you want to look at the switch to the daily real quick, we haven't had our entry. The bulls are still in amazing control right now on the daily chart. It went sideways and it broke out yesterday and today.
So we're waiting. As this comes up into this area, we're waiting for a reversal. Ideally, it's going to be a big one because those are more powerful, or it may make a M top. We don't know. But what we do know is that the analysis that we just went through, the monthly is no longer in an uptrend. The weekly is no longer an uptrend. It's turning up toward a resistance area. How far can it go? And that's the unknown, but we wait for it to form a reversal pattern, which we don't have yet. I even explained pre-market that when this first went down and it gapped below, that was the beginnings of a reversal, but it got reversed or negated yesterday. And now, you know, it's a narrow range day. We don't know where this is going to end up today. It could turn back down, and maybe, you know, it starts to move up. This is the 50 period moving average, but you can see the 5-minute charts here. The NASDAQ 100 is down near the low of the day, and buyers are beginning to step up here, but the level of retracement was really quite deep. But if you wanted to take a long here, thinking that this market is going to push up, the time to do it is right now.
Yep, based on that time frame.
Retest. See that bottoming tail bar that poked to a new low on the day and it came up, and here's the retest, and it's inching up.
Yep, same with.
Do I know it's going to go back up to the high? No, I don't. But the reward to risk here is good, because as long as it holds this area, if buyers are going to step up again, this is the place to do it, not up here. So, but we're getting closer to that sell zone. And one of the things we've been talking about, we haven't talked about today here, but we'll be talking about in the chat room, is the market internals. And what's interesting is that option traders, and not all option traders are idiots or stupid, but there is historical tendency, which is highly probable, is that option traders will load up on bullish bets at the top of the move, just like they loaded up on bearish bets at the bottom of the move. And that's what we really want to see here. And you know, markets can turn down without that happening, but we do know that if they start to believe that this market is going to go higher and start buying an excessive amount of call options as this comes up into this area, we're going to have a very high probability shorting opportunity.
Can't wait.
Yeah, so we're waiting. Today they were still buying puts.
Wow. Yeah, the two viewers are asking about cat and shop.
All right. So cat is interesting here, and what I find interesting about it is it's a sloppy bottoming pattern. So it's not all that interesting, but I do see something that catches my eye. You know, this sloppy bottoming pattern, this breakdown that failed, this red bar that was ignored on the gap up, and now it's consolidating here, which suggests that it could try and move higher. It would have to clear the high of that red bar. So I don't know, I'm not loving it on the weekly, but there is a retest, but it's got this giant bar here. So this is one of those situations, man. I think you'd agree that if we could get far enough away from it in a short amount of time, we'd sell a put credit spread on it.
Absolutely. And I'm going to write it down to see if we can get some juice for this Friday. Yeah, we love selling out of the money calls and puts. short-term dated to expiration, where we're just looking at a chart using technical analysis and saying the odds suggest that this is either just going to continue going sideways or up into Friday expiration, and the premium that we sell is our potential maximum profit.
Yeah. There isn't enough juice, as you call it. Unless you want to get real close, like 128, and that's really not much there if you're selling a spread.
Right. No, I would do it under the wide range bar. Yep.
Yeah.
Last week's low.
There's nothing there. I mean, the way we do it is really simple. You know, we just see days to expiration. That says 2 days. Is the spread tight? You know, what's the difference between the bid and the ask? How far away? Where's the major support? So that would be that big reversal bar there is a significant low. And so as long as it doesn't go down there for the couple of days, you get to keep the money. Is there enough, Dan calls it juice or premium. So, we looked at yesterday, and one of the traders in the room, I guess it's working out quite nicely for him. I found the pattern. And he did it pretty tight, Dan. I think he did a 148. I think this was like 80 cents by $1 something or $1. The 148s by, I forget what the other strike was that he did it, but it was relatively close, but the juice was there and it's working out nicely.
Perfect.
Yeah. I don't remember what the other strike was, but I think this, he took in, I'm guessing like 55 cents with the
spread. Probably $5 wide is what kind of my guess.
Yeah, so that was good. So even options can be relatively easy depending on the approach, but looking at the charts, you know, so we find lots of patterns, but we don't always find the premium. Right? Not that we can't find it, it's just not there for whatever reason. But as you one of the things you have to watch out for is earnings, because a lot of times we do find that all of a sudden it's like, wow, look at all the premium that's there, but it's like, okay, the earnings are due in 2 days. You know,
why don't you show them Tesla? We sold a put spread on that for Friday. And our weekly options trader does exactly what you're watching us do right now, selling these out of the money calls and puts that expire 10 days or less. The fewer the days, the better. Why? Because we're getting paid for a short amount of time of risk. So Tesla here, we're looking at the fangs. We're all acting pretty well this morning. And it broke out of this little consolidation. So we sold an out of the money 330 put, which is $4 under the low of that red bar. We bought a $10 out of the money put to make it a bull put credit spread. And we took in 65 cents a share. So if you sold a 10 lot, just using even math, that's $650 that is yours to keep Friday at 4 p.m., provided Tesla is trading above $330. That is how we sell options and spreads around the patterns. But if you didn't know how to read charts, you know, a mechanical person might say, well, I don't know what they would say. They would just look at the Greeks and their mechanics. But I have a bullish bias on that. So I think with the charts, the odds are staggeringly higher that this chart is going up or sideways. So why would I mechanically put on a bearish trade if I have a bullish bias? And that's why we keep saying using technical analysis for any trading methodology you use is a huge plus.
And the entry point was here on the pullback.
Right.
So we saw how strong it was, and then as it pulled back right here, right, you get a little bit more or better prices on the pullback. So we use intraday chart with a daily chart to pinpoint the entry. You get a little bit more.
I think you've convinced me that chart analysis works.
Well, I think I did that 25 years ago, Dan.
Correct.
If everybody, hopefully everybody here is getting convinced that the chart analysis works, right? So, look, chart analysis is about putting together a method, a systematic process of putting together trends and multiple time frames and market internals, and that's what we do. You know, and the patterns. What's the broader markets doing? What is the sector doing? That's the top-down approach of looking at the markets and sector. And why we do that? To see where the money is flowing into or out of. And is money flowing into the majority of broader markets and sectors at the same time? That puts the odds in your favor. Find stocks that are showing relative strength, puts the odds in your favor. There are corrections along the way. Now find the stocks and sectors that correct less. So it becomes, like Dan said, I think earlier, it's factory work. And
Fun factory work.
yeah. So factory work by definition is boring, right? It's like, okay, I take this and I put it in this box and I put tape in the box, right? And I put it on the, more like what the person does at the airport, weigh the bag, throw it on the belt, right? And so on. Well, it's not so boring in the market because there's all these variables and things change from day to day. And if you're an intraday trader, it can change from hour to hour. So, and as these things change, it challenges us to be objective and stay disciplined and follow the plan. So that's what makes it fun. Our factory work is fun. We love it, and we love the challenge. When you're wrong, it's kind of like a little jab in your side there, whatever. But the money management rules saves us, and so it's just a paper cut, so to speak. And but it's the whole thing of learning the analysis. If you're an options trader, you learn the foundations of options, and you put together your trading plan. But if you don't get the money management part out, you're dead sooner or later anyway. So with that being said, Dan, I'm going to end it here, and we will put this one into the can and get it out to everybody in a day or so.
Yep, sounds good. Yep, I hope everyone enjoyed that. Feel free to email us with any further questions. Dan at Master Trader, Greg at Master Trader. We have our MT Lives every Wednesday at noon, but the little Tasty Trade special webinar that we're going to have is a week from tomorrow.
I may be able to get the link to that for everybody here, which should take me a second.
Yeah, that'd be great.
If they want to sign up. I think one email was sent out, but let me get the link to that.
And it, just as you're looking for that link, and it's not to bash Tasty Trade. I have tremendous respect for their talent, and a number of other firms have similar approaches. So we're just wanting to have a candid, analysis discussion of the different ways and approaches to trading options. And we want to convince you, like we've done today, of trading options or stocks, that using technical analysis is going to turbocharge your returns instead of just doing it methodically.
All right, everybody, if you have questions, you can email Dan at Master Trader or Greg at Master Trader. We're here to help and get to know you, offer you to take a course, join us in the green room, which I'm going to open up right now.
All right, sounds good. Good trading, everyone. Have a great day.
Bye-bye.